All right. Thank you, everybody, for joining this morning. This is Pat Swain from the Thompson Agency, Sales Vice President. And I really appreciate everybody taking the time to join this month's webinar. And this month's webinar is called Using Life Insurance to Supplement Retirement Income. So diversifying income sources in a volatile tax environment. So I really hope that this is going to be worth everybody's time. I really do believe it's going to bring a lot of value and that there will be clients that we can find for these types of sales. So I'm going to go ahead and get started, and we're going to save questions until the end, but I plan on leaving at least 5 minutes or so for some Q&A at the end. All right, so as I mentioned, today we're going to discuss retirement planning opportunities that quite honestly get overlooked. So for some of our clients, retirement is just around the corner. For others, it's a long distance drive. And we all know that the best way to get from here to there, whether it's Cleveland, Ohio to Disneyland or to retirement, is a map. But what happens if some of those roads are closed in the future? What if another massive economic downturn closes a highway? What if unexpected legislature changes shut down one of those bridges? And what if, God forbid, our client or their spouse are taken from us? As the future becomes less clear and more uncertain, our clients need flexibility in their retirement planning. They have to have the ability to reroute. So today we're going to discuss how we can supplement an existing retirement plan, not replace it, supplement it, to add flexibility to your client's retirement planning and enhance control. So I think you'll be surprised that life insurance, yes, that financial product that we most associate with death benefits, has living benefits with the potential to add significant flexibility and to control your retirement planning so that if one highway is shut down, we can use another. So let's review the retirement allocation options that are available that many of you are definitely familiar with. So the first option is use pre-tax dollars and tax-deferred contributions such as IRAs, simple plans, and SEPs, et cetera. So although this bucket is funded with pre-tax dollars, there's going to be government-imposed contribution and eligibility limitations on how much can be contributed each year. So everything after this tax-deferred bucket is funded with after-tax dollars. So the client pays the IRS and then can invest the remaining funds into stocks, bonds, mutual funds, et cetera. And the advantage that this bucket has over the tax-deferred bucket is that there are no government-imposed restrictions on how much can be invested. However, the one problem with this bucket is that it leaks taxes. So we're going to call this the taxable bucket. Now, we have a third bucket that would include investment vehicles such as municipal bonds and Roth IRAs. And again, there's no government limitations on the amount that can be invested into the muni bonds. However, there are contribution and income limits for Roth IRAs. And the main advantage of this bucket is that income distributions can come out income tax free. So we're going to label this bucket as the tax advantage bucket. So by utilizing all three buckets, an investor can begin to try to manage taxes on distributions. But what happens to the tax deferred bucket when it's time to take distributions during retirement? Those tax deferred assets become taxable. So gains from taxable instruments are going to be included in the client's adjusted gross income, and gains from tax-exempt instruments are added to adjusted gross income and become part of modified adjusted gross income, which may impact income taxation and also eligibility for other government programs. So both AGI and MAGI can lead to tax shrinkage, whereas tax-free income is not reduced and is available as net after-tax cash flow. So your clients may be able to realize more net after-tax retirement cash flow by diversifying their sources of retirement income. So too often I find clients have not considered the tax consequences of their retirement planning. So let's take a look at taxes and how adjusted gross income and modified adjusted gross income can affect the amount your clients have to actually use to spend on things in retirement. So most people are aware that we have a progressive tax structure in the US. meaning that the more taxable income that we report, the higher the marginal tax rate becomes. But not only do we have a structure that is progressive in terms of the level of money we make and how much we pay, but we also have different filing statuses. So a lot of people don't take this into account when planning. Married filing jointly or single, head of household, or a qualifying widow with a dependent child. But married and single are definitely the two most common. And generally, when we reach retirement, it's as a couple, which would be married filing jointly. But sometimes down the road, or most of the time down the road, one of those people generally predeceases the other, leaving the surviving spouse in a single tax bracket. So suddenly the surviving spouse is going to have higher taxes even though they have the same income, simply because they had a filing change. So not only should we be aware of changes of filing status, but as we previously discussed, taxable earnings are includable in AGI, which affects a number of credits, deductions, and other government benefits. So here's a listing of them, and I'm going to go through just a few of these in a second. So AGI is going to affect a number of tax credits, first of all. And again, there's 4 up on the screen there. Hope and Lifetime Learning Credit, American Opportunity Tax Credit. So your AGI is definitely going to affect what we can get for tax credits. But where it's also going to affect your Schedule A deductions when that adjusted gross income increases. So miscellaneous itemized deductions and total itemized deductions may be important for upper income taxpayers. Charitable contributions are a big concern for the affluent. So all of these deductions are going to be affected by the client's AGI. Likewise, AGI is a factor in determining the amount of Social Security income that's going to be subject to taxation. So there are 3 possible tax regimes for Social Security. If we are under $25,000 when filing single, or under $32,000 when married, we pay no additional tax on our Social Security benefits. Remember, what we pay into Social Security has already been taxed. And if we have income above these levels, we pay tax again coming out on as much as 85% of that income. If it's over $34,000 or $44,000, depending upon the filing status. So many of our clients we work with will be in this tax bracket, and their Social Security income will be affected by their modified adjusted gross income. So just another thing to take into account when planning for taxes in retirement. Another aspect is Medicare is affected by modified adjusted gross income. So monthly premiums for Medicare for those with modified adjusted gross incomes below $85,000 are $99. But as your modified adjusted gross income increases above that, those premiums can skyrocket to as much as triple. So that's a fairly significant chunk out of retirement income just by triggering additional Medicare premiums by virtue of having income. So one more thing to take into account. And then we have the Patient Protection and Affordable Care Act, or what's commonly referred to as Obamacare. This is also affected by modified adjusted gross income. So one of the key provisions, Section 1401, provides a refundable tax credit on a modified adjusted gross income based on a sliding scale for healthcare premium assistance. So we've hit on 3 government programs, Social Security, Medicare, and now Obamacare. And the benefits or costs of these programs are all tied to the client's modified adjusted gross income. So it's likely we'll see more and more needs-based testing based on a client's modified adjusted gross income come into play in the future. So a modified adjusted gross income may very well determine how much each and every person in this country pays for healthcare. And another thing we need to take into account with taxes, or rather with income, is federal student aid. So really on whether or not a client can qualify for student aid is going to be impacted by the client's modified adjusted gross income. So these are just a few of the credits, deductions, and benefits that adjusted gross income and modified adjusted gross income affect. And as I said, modified adjusted gross income is likely to become the means testing for government benefits in the future. So I just wanted to bring this to everybody's attention before I get into how life insurance can be a benefit in somebody's retirement plan. So when a client takes income out of a traditional asset, their tax expense increases. Why? Well, a progressive tax structure and reduced availability of credits and deductions. So an increase in income also is going to increase taxes on Social Security benefits, which is therefore going to decrease what they ultimately receive. And an increase in income will also increase premiums for Medicare all the way up to triple. So greater tax expense, lower Social Security benefit, and higher Medicare premiums, all due to increase in income. So the normal assets that clients may hold for retirement are taxed in a variety of ways, and income from them may significantly affect their access to government programs like Medicare, Social Security, and Obamacare, and others. But what about life insurance? How is it taxed? Well, proceeds from life insurance can sometimes be taxed as ordinary income. However, it is possible for death benefits and some living benefits to be realized without tax shrinkage. So here's a few of those provisions that state the tax benefits of life insurance. Section 101A tells us death benefit proceeds are generally income tax free. The inside buildup of cash surrender value is generally not taxed. And Section 72 says policy loans are not includable in income on non-MEC policies. Also, there's no penalties for early distributions or leaving it in for too long. There's no RMDs in life insurance. And life insurance can also be exchanged income tax-free into an annuity via 1035. So when designed properly, a life insurance policy's death benefits and living benefits in the form of policy values provide a taxed advantage vehicle. Probably nothing that everybody on the phone wasn't aware of, but I just wanted to give you the technical explanation behind that. So if income taken from traditional retirement assets can increase your client's tax expense and affect the cost of or access to government programs like Social Security and Medicare, how does cash flow from a properly designed life insurance policy affect their tax expense and government programs? Well, as we just saw, under current law, cash flow from a properly designed life insurance policy is not reportable as income. So it has zero effect on how much the policyholder pays in taxes. Also, it will not affect how much they receive in Social Security benefits or how much they pay in Medicare premiums. So no negative effect like any reportable income would cause. So now that we understand that different assets are taxed differently, let's look at the practical effect of these differences in retirement. Let's take a 401k, for example. A 401k participant originally used pre-tax contributions to fund a tax-deferred vehicle. Excuse me. In other words, the participant didn't avoid taxation. They just delayed taxation. So if that participant takes out a $20,000 distribution from their 401k, it will be taxed at their current income tax rate. So let's assume 28%. So once we subtract out the taxes, the participant's left with $14,400. Now let's look at the effects of taxes on a properly designed life insurance policy. The policyholder would use after-tax dollars to pay premiums into the life insurance policy. And at retirement, if they took the same $20,000 distribution, they're going to be left with $20,000. So pretty obvious there. But here's a question for you. With income taxes currently near historical lows, the Great Recession, rising costs of healthcare, multiple wars, the deficit, a national infrastructure in much needed repair, and a social safety net that will be relied on by more and more residents, do you think tax rates in the future will be the same, lower, or higher than they are today? Many advisors and clients feel taxes will go up. So something to definitely keep in mind there. So during the pre-retirement phase, most clients take advantage of many deductions. They're lowering their effective tax rate by doing that. But in retirement, most retirees won't have children to claim as dependents, and many retirees plan to have the house paid off, eliminating the mortgage deduction. So what happens to these vehicles if taxes go up? Let's say 35%. So now the plan participant is paying $7,000 in total taxes, leaving them with $13,000. If we're taking it out of the life insurance policy, they still have the same $20,000 net after tax cash flow. So it's something to think about there. So now I'm not by any means discouraging your clients from contributing to their 401k. Many employers match on 401k. That's free money. I'm just suggesting that adding a properly designed cash value life insurance policy as part of a client's retirement plans gives them more options. And to better understand why a client might use non-reportable cash flow from a life insurance policy, let's look at a client's different needs and wants in retirement. So for example, we have a client's base needs like food, shelter, clothing, transportation, and these are expenses that they budget for, typically on a monthly or bi-monthly basis. So they're regular and expected, but the client's also going to have wants, things like travel, entertainment, gifts, a motorcycle, a new car, and some of these expenses will occur regularly, but on a larger time frame, maybe once a year. And then we have dreams, maybe funding for grandchild's college education or buying a vacation home. These items are big ticket items and are typically substantial in expense, but infrequent. And lastly, we have our legacy planning. So what they leave behind for the benefit of their loved ones. And as we become more financially dependent, we start to focus higher on the scale. So what we find though, when we look at these expenses, that the higher up the scale, the less frequent they become. So food, clothing, shelter, those are daily needs and expenses, and those are planned and expected. Legacy, however, that's a one-time event. The thing about legacy, some people will say, I don't even think that I'll have a legacy because I don't know how much money I'll have when I die. But keep in mind, everyone leaves a legacy, even if it's a legacy of debt. So we all have a legacy. It's just a matter of what kind of legacy we leave. So how are the clients going to pay for these expenses in retirement? The distribution phase of retirement is generally structured where clients use 401k, Social Security for their needs and some of their wants. So typically they'd use their annuities, dividends, and interest for some of their wants and their dreams. And their legacy is usually a conversion of unused assets. So I'm going to suggest that you can supplement this traditional planning with life insurance using living benefits for some of their needs or wants and dreams, and the death benefit to fund their legacy. So using life insurance to pay off debt may be a great way to turn that legacy of debt into a different legacy. Now, here's where I want you to relate back to what I was talking about earlier about taxes. Think about that client that's in retirement and wants to educate a grandchild, or wants to build that summer home, or finally buy that RV. Taking income from these traditional assets is likely going to cause these same assets to be taxed more, which means less and less money in their pocket to pay for those expenses. It may also affect their access to and costs of government programs. So life insurance gives clients the potential flexibility to fund those wants and dreams without increasing taxation expenses, because the cash flow from life insurance does not affect their adjusted gross income. So life insurance can be a tax-efficient option to address those needs during life and potentially be a solid asset for a lasting legacy. Does it make sense then to have the flexibility and control to access cash values of a life insurance policy? Well, let's take a look at what types of options it provides. Let's take a look at option one. Client wants to retire at age 65 and take Social Security at 65. They deplete their assets and hoping to have passed away by life expectancy. So this is a plan for a lot of people. Not much, not many options there, not much flexibility. If they outlive life expectancy, they may have a shortfall for income planning. Option two, maybe to still retire at age 65, but to deplete assets to life expectancy. If they live past life expectancy, they might have the option to access life insurance cash values. And if not, then the death benefit could be transferred tax-free to their beneficiaries. But what about another option? A lot of clients want to retire prior to age 65, but doing so will entitle them to a lesser Social Security benefit, we know. So one option may be to be retired at age 63 and access cash value from life insurance values until age 65 when they begin taking Social Security. So of course, there's different ways to structure a retirement. A retirement for many of you is 15, 20, 30 years away. But does including cash value life insurance as one aspect of your retirement planning increase your flexibility and control or decrease it? So I want to make sure we have enough time for questions. So I'm going to move ahead a little bit, but I wanted to go over this example. Here we have Robert. He's age 50, average health, we'll assume standard, and he wants to protect his family. He's maxed out his 401k, but also desires additional cash flow for retirement. So we're going to propose a Lincoln IUL. Again, we have access to numerous IUL carriers. This is just one of the options. But for the Lincoln Wealth Advantage IUL, you get a guaranteed floor of 1% and a cap of 10%. And properly structured, we're going to be able to produce tax-free income and some potentially strong leverage. So he's going to plan to pay in $15,000 over the next 15 years, or a total outlay of $225,000. He's going to allocate 100% into the capped account, which again has that 10% cap and a 1% floor. We're going to minimize the death benefit, which gives him a minimum non-MAC death benefit of $239,000. And we're going to have the death benefit increasing and switching to level once he's done paying premiums. That's an optimal way to build cash and produce a strong tax-free income stream. So what do the results look like? Let's look at a range of returns for our 50-year-old male who contributed $225,000 over those 15 years. So these annualized distributions are solved to ensure that the illustration does not show a lapse. So we'll notice there's a significant range of distributions from a high of just over $26,000 per year to a low of just over $12,000. But even at 3%, this design does not lapse and still produces over $12,000 a year. And when we look at those distributions over 20 years, the client's still getting back what they paid in premiums, tax-free. And for those advisors who are concerned about the IUL blowing up, like the current assumption policies they may have sold in the 80s, this can be a compelling story. In other words, there's some leeway for error here as long as it's properly managed. And if we look at the IRRs, they're extremely attractive. When you look at IRRs, it's almost a way of figuring out what the cost was to the client. At a 6.5% rate of return, your cost was the difference between that 5.12 and the 6.5. So, a little bit more than it would have been in a mutual fund, but keep in mind, this is tax-free. So if we look at a pre-tax IRR at 35%, that gets increased to 7.88%, which is quite attractive. So the living benefits from a properly designed life insurance policy can definitely be an important part of a broader retirement plan. So those benefits can help supplement an existing retirement plan, like 401ks or annuities, add flexibility, and enhance control, and even protect the family. Again, this is life insurance at its core. It's going to have a death benefit that's left in the back end. So helping your clients reroute if roads or bridges are closed on their way to retirement. So it looks like I finished it in just about almost 30 minutes. At this point, let's go ahead and open it up for questions. If anybody has any cases, I just want to make a comment. I think, the ideal prospect you want to find for supplemental retirement planning is somebody with at least a 10-year time horizon before they're planning on pulling any money out. Somebody who's probably going to have a tax they're going to have a tax issue in their retirement plan. In other words, they're higher income earners. Also, people who are maxing out their 401ks, maxing out their Roths, or can't contribute to Roths. This may be a great option to help supplement. There is a question. And the question is, are there any limits on a plan like this? And can an individual put in more than Roth IRA limits? And that's a great question. And the answer is no, there's not any contribution limits as long as they can qualify for the death benefit coverage, because that's what a life insurance carrier will underwrite. There's no contribution limits. So, from working at Lincoln for the last 9 years, I could tell you that we saw a lot of wealthy people putting in $50,000, $100,000, $200,000 because somebody making, $200,000-$300,000 a year, maxing out a 401k is not going to get them to their retirement goal. They're going to need something to help supplement their 401k and their Social Security benefits. And to have a tax-free bucket of money is going to be hugely advantageous. So great question. A lot of people called this the rich man's Roth. When I was at Lincoln. Any other questions? Well, I appreciate everybody joining the call this morning. Hope everybody can find some clients that match this type of profile. And if anybody wants to contact me directly, my cell phone number is 860-836-5521. All right. Well, I hope everybody has a great day, and this will be recorded. If anybody needs to, watch it again or pick up some information they didn't get the first time. All right. Everybody have a great day. Thank you.